I'm Rick Plum with this week's Lucia Capital Group Weekly video. Have you thought recently about selling your home? Well, if so, you might be selling at a pretty good time. The Case-Shiller U.S. National Home Index tells us the average price of homes across the country has gone up more than 104% since January of 2012, 10 years ago. Now that really adds up to a lot of gain for some people who live in certain housing markets around the country, especially if you've owned the home for at least the past several years or more. But because your home has risen so much in value, you might also be concerned that selling your home may trigger a big tax bill from all that gain. It used to be that if you were under a certain age, you had to buy a new home of equal or greater value within a couple of years or face that tax consequence. But those rules were changed a long time ago. Now, you may be able to keep most, if not all, of that money that you get from the sale of your primary residence, thanks to the little-known Section 121 of the tax code. Now, Section 121 is one of the provisions that came around from the Taxpayer Relief Act of 1997, and it allows qualified individuals to exclude up to $250,000 worth of capital gain from the sale of their primary residence, or even up to $500,000 of that gain when filing a joint return with your spouse. You can actually keep those gains tax-free, and you don't have to buy another home or more expensive one to get this tax-free treatment. Now, of course, like everything else in taxes, you have to follow some rules and meet certain standards in order to take advantage of it. So how do you qualify? Well, first and foremost, you have to pass what's called the ownership test and the use test. On the ownership side, you have to have owned the property for at least 2 years, 24 months. On the use side, you must have occupied the home as your primary residence for at least 2 of the last 5 years, or to be more precise, 24 months of the last 60 months before you sell it. Using it as a vacation property from time to time won't cut it. It has to be your primary place of residence to meet the use rule. Now, if you own a vacation home or a rental property that you move into and then establish it as your primary residence, you'll have to prorate the gain ownership across the different ownership time periods. Some of the gain will be primary residence gain, eligible for the exclusion, and some of it will be due to the time it was a rental or vacation property, and that gain cannot be excluded. In certain instances, you can get a portion of the gain tax-free even if you don't fully meet the 24-month rules. But those are fairly rare exceptions. And by the way, the 2 years of residency and the 2 years of ownership do not have to be concurrent. So if you rented it from a previous owner for a couple of years before buying it, that can still potentially work to meet the use test. Now, another rule is that you can only use this particular exclusion on one home sale in any 24-month period of time. So as long as you haven't used the exclusion on another home within 2 years prior to or after the sale, you may qualify. Now, I said earlier that a married couple filing a joint return can qualify for an exclusion of up to $500,000 on one home. In order to do that, though, you have to show that all of the following are true. You're married and file a joint return for the year of sale. Either you or your spouse meets the ownership test I described a moment ago. Both you and your spouse meet the aforementioned use test, and during the 2-year period prior to sale, neither of you excluded gain from the sale of another primary residence. Now remember, just because you can exclude some or all of the gain on the sale doesn't mean you won't have to show some accounting for it on your tax return. If your real estate closing agent issues a Form 1099-S, then you'll need to demonstrate to the IRS on your tax return why you're excluding the amount of gain. It's kind of a hassle, but you're required to do it. So it may save you some time if you can prove to your agent, with all the proper documentation, that you don't owe the taxes on the gains and they won't issue the 1099-S. Either way, given the fact that for many taxpayers, their residence is often the most valuable asset, this is one of the best tax breaks out there. So if you qualify and you decided to sell your home, it's a good idea to take advantage. This is all part of the financial planning process, something we advise our clients on all the time at Lucia Capital Group. How can we help you the most? Just give us a call.